This is sort of three questions in one, in my opinion. That's a great question, but I think, Chris, it's kind of three questions in one. But let me make sure that I can think about this how I want to approach this. It's a pretty easy question, but there's a couple moving parts in it, for lack of a better term. Chris says, Mike, I'm sure you've heard of the wheel strategy. If I were thinking of putting on a married put on a stock where we buy the stock, buy a far out in time put option to control risk to single digit percentages. And of course, it's a bullish strategy where we're going to apply other income methods to reduce the initial at risk on that trade. That's the married put approach. But Chris is wondering, with the concept of the wheel strategy, where essentially you sell a cash secured naked put out of the money, and if the stock falls, you allow it to be put to you, and then you just convert it to covered calls. Investors have been doing that for decades. Okay, it's just a common management approach for a cash secured naked put. Yes, there's some other discussion of stock criteria and deltas that you look for in the quote unquote wheel strategy that's in that book by Mark Hoftegler. I'm never going to say his name right, and I apologize to him for that. He's got other criteria that he looks for that specific strategy, but in general, the basic approach of the wheel strategy has been done for decades, and no one really called it the wheel. It's just, hey, I'm in a naked put on a stock I wanted to own. It fell a little bit. It got put to me. Hey, I wanted to keep trading it. That's why I sold a put on it, because I wouldn't mind owning the stock. Now I'm just going to start selling covered calls against the position to keep increasing premium on the position for a long-term hold or a short-term hold if you get it back to break even. In any case, so Chris says, with the wheel strategy, if I were thinking about putting a married put on a stock, what is your feeling about selling a cash secured put to reduce the cost basis of the stock before buying it? Okay, so there's two concepts on this that could be discussed. Actually, technically three, Chris. We've covered this in other presentations. I'll allude to those later. There's one that discusses the three core principles and trade comparison, where we compare what we're going to take a look at right now in the next 10, 12 minutes or so, the naked put to open a married put strategy at a lower price versus why not do the in-the-money long strangle? Instead of buying the stock, buying in-the-money call and buying in-the-money put and do it that way. Or, just buying the long call instead of buying the married put position. So we tackle the pros and cons in the presentation of those three approaches compared to the married put strategy. Now, number one, this type of market, Chris, we've seen the last 10 days is one of the reasons why I might not have considered entering this position with a naked put as opposed to buying the married put outright. And a reasonable example of that is what we just kind of covered with Barry. We can take a look at that. But what do I have in a naked put position? Well, a normal naked put approach, I'm going to go slightly out of the money, maybe for a 5-day trade, a weekly trade, for example, like the weekly picks of the day. I might be looking for a 0.5, 0.8% return for a 5 to 7-day trade. 4 or 5% out of the money, giving myself some good downside protection, Chris, of course, and still generating the premium I want. If I'm selling out to February, a true monthly naked put, I might be looking for a return of around 2.5%, maybe hopefully 3%, depending on market volatility and the types of stocks that I'm trading in that case. The premium collected and the range out of the money might give me a good percent to break even of, say, 7, 8, 9% decline. Or if I'm neutral to bullish on a stock to begin with, I would just maybe perhaps get into the married put position where I have the protection in place and the positive delta if the stock moves up to gain on the trade. Remember, on the naked put, you can't make more than what you collected on the premium as you start with. So the dilemma here is that the protection that you get with the naked put, even if you wanted to get into the position at a reasonable price, if the stock falls too far and you're up here and now you're thinking of converting it to a married put, you run the risk of the fact that the put that you could have bought initially when you first saw the married put position with a controlled risk of 5 or 6%, you're not seeing that put anymore. Now that the stock has fallen, volatility has increased, the put that you're looking at to ensure your position at your new cost basis with the stock trading at a lower price is not going to give the same protection. And if volatility is increased too much, paying into that extrinsic value, the true risk on a married put position is the time value of the put you're paying into, is likely to be higher. You're going to have a much higher risk on the new position than you would have on the initial position you started with. And I think we're going to be able to try to illustrate it. We're going to try to illustrate an example of this, Chris. Let's go back to where we were, January 18th. And I'm just going to stick with Barry in this case, just because we've seen what it's done and we know what the examples are. And actually, here's what I want to do. I want to go to married put, and I'm going to go to backtest first. And I'm going to go to search by symbol. And we're going to look on January 18th. And I'm going to look up, of course, BERY. And let's see more results. And likely, if I was opening a true married put following the blueprint, I'm probably going to be out to July or August or September if it's available. I don't remember if July series was available for BERY. Let's take a look. No. Maybe August isn't either. We might have to go as far out as October. Okay. I'll try June. That's good 6 months out. All right. Perfect. Perfect. Okay. If it matched my criteria at the time, I run the married put search on January 18th. My apologies. I see Berry Plastic come up. It's right at the limit of where I would go. I probably would have gone to an October or September, what was available, Chris. But in any case, it's a good risk. Berry at 72.14. We could buy the 75 put for June at around 675. This would put us at a risk of about 5.6%. We know Berry's trading around $66, $67 right now. So it's fallen, about 8-9% since this trade was open, 7-8% since this trade was open. Okay, so no, I don't want to analyze position. I'm actually going to enter this into a portfolio as well so we can see where we stand. And that's June 75. My apologies, it's 675. So it's a good controlled risk of 5.6%. And let's go back now to the portfolio. Here we go. We're going to just keep it in the spreads portfolio. We're going to enter our married put position for BERY 72.14. 100 shares first. Keep the trade date even. 72.14 at the close. And June, it was September. June 75, right? That's what we had there. It's a June 75, yeah, it's 675. Great. So here's our married put position. Stock's down 7.1%. I'm only losing 1.5% on this position. Stock has fallen $5.11. It closed at 67.03. And our puts moved up from 675 up to 1070. So we're only at a 1.5% loss on this particular position. That's good. Let's compare now. Probably with the stock at 72.14 on the 18th. I'm guessing if I was going out, well, we could have gone to January, couldn't we? This is a shorter term trade, Chris. Let's take a look here. Let's see. Oh, we just want the puts. Oh, yeah. So it was only 3 days out. I wouldn't have sold any of these. We're going back to February. I know we're doing just a monthly, Chris, not doing a weekly comparison, but that's okay. 30 days out, 1.5% return. That's a little bit lower than I'd like. Oh, no, that's not my return I want. I am really sorry. Where's my time value? I didn't have it added. Got to add 2 columns, Chris. Make sure we're analyzing this correctly. What do we need for a naked put? We need... No, I don't need the volatility. Here we go. Percent naked yield. Percent time value is helpful. Probability I'm going to ignore. What I really want to see, instead of the probability above, I want to see that. I'm sorry, I'm looking for something specific and I'm not seeing it here. There it is, percent to break even. That's sort of the downside protection of a cash secured naked put. Downside protection we use for covered calls. Percent to break even is what we use for the cash secured naked puts. What does it mean? How far can the stock drop before we're technically losing money on the position? Okay. So 67.50 here. That naked yield, yeah, was right around the downside protection, 1.6, 1.5% with an 8% to break even. So that's pretty attractive. But what did we say? We're probably looking for 0.5 to 0.8% return, Chris, on a weekly cash secured naked put. Probably looking for 2.5 to 3% on a monthly naked put. I most likely would have chose the 70 strike put here, 2.6% naked yield, 5.5% to break even. Yes, lower probability, but in this case, remember, I'm selling it to potentially get into a naked put with the stock only at 72. I might not mind getting assigned at 70. I might not want to go too deep out of the money because I eventually want it to be assigned, right? To convert it to a married put position. Okay, if I keep collecting decent premium on it, maybe I'm okay if it doesn't get assigned, just like the wheel strategy, of course, Chris, I understand that. But here I'm saying, hey, I'd like to get into this stock instead of buying it at 72.14. If I sell this 70 put right now at 185, well, that's monetary break even is going to put us at 68.15, right? That looks pretty attractive over 72.14. So let's go ahead and do that. Let's go back to the portfolio. Let's enter in our short put position. January 18th, we are going to sell the February 70 strike put just at the money. We'll go ahead and call it that. The 72.5 was really the one that was at the money, but this is close enough. We're going to generate a good premium of 185 in this case. Okay. Oh, stock price at time of trade. Yeah, that might help with some of the analysis, but we don't need it really. We're going to put that in. All right. Where's my naked put down? Naked put position is down a total of $250. Only 3.6%. Buyback cost right now is $435. On the same day, I could have opened a married put with a risk of only 5.6%. The June 75 strike put with my cost basis, we'd only be down 116 or 1.5% with a 7% decline. Here we're down about $250 on our cash secured naked put, or risk of unrealized of 3.6%. Now let's take a look at our profit and loss chart here and analyze something. Doesn't always happen. Oh, sorry, went too far there. I just want to go to about here. Yeah. Here we go. So we're still holding the 70 put. The stock's at 67.03. We still have 21 days to go. So it's unlikely we would have been assigned early on this position. The stock, by the way, was as low as 66. I don't think it ever went below 66. It might have intraday. The last few days I've been watching it. But I think the lowest price I saw was 66.05, maybe 66.10 in any case. So that would put us where? Well, probably about a $300 loss on this one. It probably would have been about a $200 loss on the naked put. It would have gone up a little bit more. Would have gone against us a little bit more. Yeah, so what do we know is my cost basis if I get put this stock? 68.15, right? So with a 7% decrease, let's say that we did get assigned early on Barry, and we bought 100 shares of stock at 68.15. We're only down what? Liquidation-wise, if the stock was put to us at 68.15, Chris, I'm only down 115, 112, really, almost the same amount that the married put is currently losing. But I'm going to go back to June. I can't buy the 75 put. That's too deep in the money, right? The stock's trading at 67. The likely put I'm going to purchase is going to be the 70 strike put at 780. That would be the most likely one with the 1 or 2 strikes in the money following the married put approach in this case. And see, now where am I? I still have a good controlled risk of 6.8% on this position. But the initial position starting from scratch with the married put was only a risk of 5.6%. Now, I already have the married put in place. I could use some of the 12 income methods on that existing buried put with the stock down 7% and only that loss of $115 or so. I could manipulate that put option. I could move it closer in into a lower strike price and probably lower that initial at risk. You just got put the stock. Now the prices are a little bit more expensive in this case. The 75 is probably too far out of the money. It would go against what I'd normally look for in a married put position in this case, from starting right now with a cost basis of 68.15 and 67.03. And I have a higher total at risk now in this position if the stock continues to move down against me than I would have if I initially opened the married put to begin with. That's an example when the stock, of course, has declined. If the stock had continued to move up, let's say it moved up 2 or 3 points, well, I'd still realize 50 to 60% of that gain on the married put position due to the positive delta of around 0.5 or 0.55 or so, somewhere along those lines, Chris. And then, of course, the naked put, the most I could make is the 185 that we collected in the premium, that 2.5%, 2.6% return we saw come February. So it's a trade-off in that scenario based on the type of stock you wanted to. But doing it in this way, although you collected the premium and the types of declines we're seeing in the market now, we end up with a higher percentage at risk after the decline and the stock falls below our put if we're assigned than we would have had we just entered the married put initially to begin with. Of course, these are both the worst case scenarios. Both this 6.8%, which is 1.2% higher than the married put we could have entered on January 18th, buying the stock at 72 and buying the June 75 put for 675, I think I said it was. Yeah, 675. But both are the worst case. If we continue to hold the position all the way to June expiration, Chris, and we don't do any other adjustments, we accept no dividends in that scenario, and the stock still stays below 70 in your case, which would be below 75 in my case, then I'd have the full risk of 5.6%, and you'd have the full risk of 6.8. Yes, we're going to plan on doing some adjustments. We're going to plan on rolling those positions, managing those positions, and more. Now, another thought that comes in, which we describe in that 3 core principles video and trade comparison about the naked put to the married put. Remember, the market did decline. All right, we're down 7%. And I'm not saying I was bullish on January 18th, but had I entered a married put on January 18th, it's because I had the expectation that the stock I'm trading has the potential to move up 3 to 5% in the next 35 to 60 days. No, I should say, I'm sorry, 20 to 40 days is my target in that case. So that's when I open a married put. I look at the married puts in the search. I look at the stock chart and some of the other company information. I like to pick the one that I feel has the best looking potential based on how I analyze stocks of moving up 3 to 5% in the next 20 to 40 days. And by the way, historically, that usually happens to me about 68, 70% of the time. Of the positions that I open, normally within those first 20 to 40 days, the stocks move up 3 to 5%. That's the perfect time to start doing those first bullish income methods, maybe a 1, maybe a 6. If it exceeded expectations, maybe use a 4 and cut the risk down by half as well. Now, the thought comes in and says, well, if you're worried about a downturn, you could still get at the stock at the discounted price and have the protection in place. In other words, on January 18th, had we sold that 70 put when the stock was at 72 and we collected our 185, and at the same time, bought the put I would have bought for the married put, our 75 strike put at the time for 675, which gave us that controlled risk of 5.6%, my apologies. Wouldn't this give you the same benefit? Now I can put the stock at a lower price and I have the existing put in place when that does happen. What you've done though is created a calendar put spread, a diagonal calendar put spread, which actually loses money if the stock moves up in the direction we expected it to go. Now, this chart might look attractive right now, but we can't get those prices. This was the price on January 18th. This doesn't look too bad of an upper break even of 77.02, a potential return for a calendar spread at 71. We can't get these prices right now. Those were the prices on January 18th when the stock was at 72. Okay, that's what we're looking at in this spread. But your upper break even's at 77.02. That's fine, but it has an upper break even. Remember, my reason for opening this married put position at the time was because I thought the stock was going to do this, that was going to move up 3 to 5% or so in the next 20 to 40 days. It did the exact opposite, went down 7%, different market conditions. But again, that's why I would have opened it. Why would I open a structure just to get the stock at a little bit cheaper price with a naked put approach, keeping the same long put, if I now create a position that's going to lose money if the stock does what I initially expected? That's why I don't open a married put with the calendar put spread, because I've actually created a bearish position. And I just spent the last 15, 20 minutes looking for stocks that I feel were bullish that had the potential to move up 3 to 5% in the next 20 to 40 days.